Okay.
Hello, everyone. I appreciate the time that you have spent to attend this webinar today. I will be presenting to you my views of the market and how I intend to strategically allocate my portfolio according to the current economic environment. Okay, next slide. Okay, in a blink of an eye, we are already halfway through the year. As you can see from this chart above, the KLCI index is actually relatively flattish since the end of 2019. So the strong performance that we see last year is actually mainly the recovery from the pandemic sell-off that we see in March 2020. As for the small caps, they also have done really well during this period. However, we are starting to see small caps giving back away the gains that they have over the large caps in the past few months. There are a few reasons to it actually. Number one, it could also be because of the current environment that we're in. We are facing, heightened uncertainty with rising COVID cases and also, political uncertainty. And during this period, investors tend to be a bit more risk adverse. Hence, which explains why we think that large caps may continue to outperform small caps as per what we see in the second quarter this year. Now, if you look at regional equity performance, if you were a foreign investor invested in Malaysian stock market, for every $100 that you've invested in end 2013, you will actually be left with only $95, $5 losses after 7 years. Now, this is very bad because the US stock markets have been delivering double-digit CAGR growth during this same period itself. Nasdaq have done really well. Not only that, despite the weak performance in the Hong Kong stock market today, or this year, we are actually seeing strong growth in the last 5 years. So for us, what we see is the biggest underperformer remains to be the ASEAN equities. If you look at this chart itself, other than Malaysia, the Singapore stock market have actually been underperforming as well. Only recently this year, the Straits Times Index have actually outperformed the overall market by a significant margin. I think most of the ASEAN stock indexes are struggling to break even at this point of time. Whereas your Singapore stock index actually is up about 10% year to date. So what we're seeing here is why Singaporean stocks are outperforming the other regions could largely be due to how they are able to contain the surge in COVID-19 cases. That is the biggest outlier that we see at this point of time. Now, moving on. Most asset classes, if you look at this chart, have actually recovered back to its pre-pandemic levels. Obviously, if you invested in anything during the sell-off in March last year, you have made significant gains. Now, if you look at this chart from its pre-pandemic level to where it is today, what we see is that ASEAN again is one of the biggest underperformers. Now, only the ASEAN index is still underwater relative to its pre-pandemic levels. Again, we took a base of 100. So for every $100 you invest in, you'll be left with about $90 if you were invested in ASEAN region. Compared to investing in any other asset classes, whether it's your world index, your aggregate bond index, your Asia Pac index, or even commodity index, which is largely a big component of the commodity index is actually oil. So, at one point, West Texas crude actually went negative last year, but again, oil prices recovered strongly. So it seems like the ASEAN region have been the biggest laggard, not only in the past few years, but last 2 years itself, we are still being one of the laggards among other asset classes available to investors. Now, if you look at this chart, what we can see is the large caps actually underperform the small caps for 4 consecutive quarters up to Q1 this year. Now, that have never actually happened before since 1998. Hence, it's not out of the world for us to see that your large caps is starting to outperform your small caps. That is what we saw in Q2 this year. And actually, if you think about it, the situation right now is quite similar to the situation in 2018. We had political uncertainty back then because we have the general election, G18, and then there's a change of government, you have new policies in place. So, during that year, small caps actually underperform large caps. And it's also one of the years that, my fund have underperformed the benchmark. Now, we are starting to see a similar trend this year, where, again, we have political uncertainty. We may have a hanging government right now. COVID cases are still going up. We are struggling to tackle this problem, and which could result into an extended risk-averse period for investors. Hence, it's not out of the world for small caps to underperform large caps in the next few quarters. Now, globally, small caps have been doing very well. Nearly every region you see, small caps are up close to 20% compared to its pre-pandemic levels. Obviously, small caps, again, was the area that got hit the hardest last year in March, where most small cap index was down 40 to 50%. However, if you bought at the bottom, you would be up more than 100% from a one-year return standpoint. Now, again, the area where small caps are underperforming is the ASEAN region again. This is quite similar to what we see when compared to its larger counterparts, where we are struggling, the whole region itself actually is struggling to contain the recent surge in COVID-19 outbreaks. Furthermore, now we are seeing, new variants in place, and also, the lack of vaccination could remain to be a problem, especially in areas like Indonesia, Philippines, where it's not so easily accessible compared to, the more developed markets. So we will have to see how things will go. But again, the only way to get out of this problem or the hole that we're in today would be through vaccination. And hesitancy to vaccinate will be a problem. Obviously, at this point in time, it's more of trying to secure sufficient vaccine supply. But then after, I would say, more than half your population is vaccinated, the next issue is how to reach herd immunity, because there will be a lot of people who are reluctant to take vaccine due to religious reasons or, myths or hearsay. So, that will be a problem that the emerging markets will face. Now, this year, retailers have done really, globally, retailers have come back in a very strong way. At the start of the year, retailers actually dominated headlines, global news, by pushing up meme Reddit stocks such as AMC, GameStop to all-time highs, or well, not all-time highs, but at least it went up 400-500%. And it dominated the headlines. Everyone cannot stop talking about it. You have retailers everywhere trying to pile in money, trying to take advantage and trying to ride the trend. So we see this trend in Malaysia as well. Since the G18, retailers actually started coming back into the Malaysian market. As you can see, 2018, we saw a net buying of 3.8 billion. And the trend have only begun to turn after the general election. After the change of government, retailers started to come in a stronger manner. So now, last year, retailers came in a very big way. Not only did they come in at 14 billion. It came in higher than what your institutionals, your foreigners net selling is. So what we see here right now is retailers will be dominating headlines. We do believe that this is sustainable. We do think that there are still a lot of liquidity in the system. With fixed deposit rates at 1.75%, we do think that retailers will constantly search for better alternatives or things to invest in. Hence why we think that the strong inflows that we have been seeing in the past 4 years will be sustainable. Now, institutional firms have been a supporter of the markets every year, except this year. Now, one of the reasons why institutionals may be net sellers this year could be because of the actions of the largest fund in Malaysia. Now, in the last few stimulus package announced by our Prime Minister, what we saw is there's the introduction of your iCitra, your iSina programs, where it's basically EPF withdrawal schemes. Now, EPF do have their strategic asset allocation in place, where they need to hold certain amount of fixed income, a certain percentage in equities, foreign equities. There's a combination of a mix of portfolio, for them to achieve the type of return they want and be able to meet liquidity needs. Now, this year with these few EPF withdrawal schemes introduced, it's not out of the world that EPF is reluctant to place more money into Malaysian equities, mainly because they may need to actually reserve this amount of money in the event that if there is withdrawals. So we do think that the next few months, institutionals may still be net sellers. And, another reason that this could happen also could be other GLCs needing to divvy up to the government. So hence they need to raise their cash reserves, which could result into, again, selling equities or their existing holdings. So institutional firms may continue to be net sellers in the next few months. Now, as for foreigners have been consistently selling Malaysian equities. They have been net sellers since 2014, except for 2017. 2017 is the only year that there's positive inflows amounting to about 10.8 billion ringgit. Now, it could be because that they were anticipating of a pre-election rally in 2017. Now, for us, there is a possibility, if for us, we look at things, if there's light at the end of the tunnel, and there is a bit. The next general election will need to be held in 2023. Hence, if we were to see the same trend that happened in 2017, 2020 could be a year where foreigners come back to the Malaysian markets in a strong way. Now, the areas that will benefit if foreigners were to come back in a strong way will be stocks that used to have very high foreign shareholding. However, it's now at record low levels. One area that I think could likely benefit would be your financial sector, your banks. This is an area where foreigners like to invest in, mainly because it's very liquid and it's a blue chip, something that they are comfortable with, something that's within their investment universe. So banking stocks may do well if foreigners were to come in a big way. Now, in this chart, you can see that every single month, foreigners have been selling Malaysian equities. Of course, in Philippines, Thailand is also facing the same issue as Malaysia, sharing the same troubles that we have. We are struggling to, contain the recent surge in COVID-19 cases. We are seeing, new cases in Indonesia as well, Thailand. The plan was to reopen, Bangkok in October, I think, but that may need to be postponed. Nevertheless, they did open up Phuket to travelers that are, fully vaccinated or within the countries, with low COVID cases. So for us, like any other ASEAN region, we do rely a lot on tourism to drive our economy. And this is one sector that is struggling badly right now, the tourism and leisure sector. Philippines, same problem again, COVID cases. Hence why you are also seeing, money in and out, net outflows by foreigners. The only one country that that's quite unique is actually India. Despite its spike in COVID cases or high COVID cases that we've seen in the past few months, foreigners are still very receptive to invest in India. I suppose it could largely be due to the narrative of its, potential consumption growth due to its large population. The story have always been the same. Could India be the next China? So I suppose that's why foreigners have been plowing in money to India, riding on the, potential consumption growth story. Indonesia as well is another country that also constantly, foreigners always like it because of the potential consumption growth story, being the largest Muslim population in the world. Now, earlier on, I did mention that I do believe that retailers do have the capacity to continue to invest in Malaysian stock market. The reason so is because of this chart here. Now, more often than not, we always hear of the struggles of the B40 and M40. We read in the newspaper, we hear in the news, we hear people that we know talking about the problems that they face, struggles, with life, and it's true. That area of your B40, your M40, your bottom and medium classes are struggling. But then the rich is getting richer. If you look at this fixed deposit chart here, Malaysian fixed deposit actually peaked at about 950 billion ringgit in 2020, compared to about 620 billion in 2013. So it's a significant surge. We're talking close to 330 billion, growth in fixed deposits in Malaysia. Despite during this period, there are a lot of people struggling with life. So this is a classic case of, your rich getting richer and your poor getting poorer. The wealth disparity is there. So for us, we do believe that T20 have money to invest in the market with the, fixed deposit rates at 1.75%. They will need to look for better alternatives, especially retirees. Previously, when they could still get 4-5% returns, they could live off that, their savings. But at 1.75%, it's difficult. Imagine back then the interest income amount to about 10,000 ringgit a month. It's literally being cut more than half right now. Even if you put longer tenure, you probably get 5,000. So unless you reduce, your expenses or expenditure, really cut back on your lifestyle by a significant amount, that too may not be sufficient. So they will need to take more risks and seek for, other investments that can give them better returns. So we do believe that this particular portion will go to the equity markets. Now, in this chart, you can see that the US household net worth have continued to grow to all-time highs. Now, few reasons that drove this growth, why Americans are richer. Number one, it could be generous stimulus payments that the government made last year. Think about it. A lot of this middle income population did not even lose their job, did not have any loss of income stream. They are still making their money, still drawing their salary, working from home, hence actually spending less on traveling, spending less on eating out because of COVID. So you see a growth in savings there. Furthermore, equity prices in US have been going up. House prices in US have been surging to subprime levels. So now what we're seeing here is Americans are just getting richer, and with interest rates at 0%, and easy refinancing, they just have more money to invest in the markets. Hence why I do believe that this party will not end so soon. I do believe that equities do have room to run. Obviously, there will be volatility in between, but nevertheless, if you take a longer term view and you write out the volatility, I do believe that there is more upside potential than downside risk. Now, if you look at this chart, we can see that the US money market mutual fund stands at about $4.5 trillion right now. Now, people talk about bubbles. US market have gone up a lot, being one of the biggest risks that people keep emphasizing on, which is true. I understand why people are concerned. Stock market keep going up 15-20% a year. It does not seem sustainable in any manner. But if you look at how much liquidity is in the system, now based on this chart itself, it's at $4.5 trillion right now in US money markets, compared to $3 trillion, prior to the COVID-19. Hence, we do believe that overall it's a function of liquidity. It's not that people have been holding a lot less cash to buy stocks. It's just that there's just a lot of money in the system. They are holding more cash than ever. Yet, stock markets are hitting new highs. So, the idea behind it is, okay, if people were to take profits out of the table, were to sell out from equities, where are they going to put it? In cash, right? Cash getting zero or very little interest rates or very little interest income in return. Now, eventually, people realize that, wait a minute, true, equities may be risky, but if I invest in good companies that give me that, even at 20 times PE, we're talking about earning 0 or 5% compared to holding cash, giving you 0%, 0.25% return. So eventually, we do believe that if there is any correction, it presents great opportunity for investors to invest in, because we do believe that people will start to plow back money back into the market. Now, if you look at this asset allocation survey done by AA22, what we start to see is actually the amount of stocks or bonds or cash, its allocation did not change much over this last 10 years. Now, obviously, during the COVID period, you can see that the cash levels actually increased, but nevertheless, it did normalize eventually. Now, from our standpoint is, if we see money market funds at all-time highs, cash allocation at its normalized levels, basically what will drive the market higher will be your US Feds. And time again, that's the case. We do see a strong alignment or high correlation between the S&P 500 or NASDAQ index with the US Fed balance sheet. In one of the charts I'll show you later. Now, in this chart, we can see the performance of the equity index during the SARS outbreak. As usual, when the SARS outbreak peaked, that is when the equity indexes bottom, which is similar to what we saw last year as well. More often than not, investors tend to look across the valley. We tend to look ahead. So when it's the best time to invest is when things are at its worst. When you think that it can only get better, that would be the bottom of the markets. If you look at the GDP of these few countries, Hong Kong, China, Malaysia, Asia Pac, again, same thing. We got hit, but eventually we always recover. Human beings, time and time again, we always figure out a way how to recover. We always come back up. It's never doomsday. Now, if we look at this chart, what we can see is the China outstanding margin trading balance. You can see that there's high correlation with the Shanghai Composite Index. Basically, more margin is available, the higher the Shanghai stock index goes up. So basically right now, what we're seeing in China is the Chinese government have been trying to tighten up credit. They have been trying to, control the strong growth that we have seen last year. Basically, the Chinese government do not like very steep exponential growth. What they like to see is a stable growth. So what we think is the Chinese government is trying to suppress growth right now to contain inflation. What we hear recently is basically the Chinese government did mention, or actually did indicate that they are telling analysts, at least that's what we heard, that do not publish very high target prices for your equity indexes. So basically, they're trying to contain whatever bubble that could be brewing right now. So for us, this explains why the Chinese government are going after their large tech companies. They are trying to tighten things up. They also actually told traders to stop, basically commodity traders or corporates to stop speculating on commodity contracts, because commodity prices have gone up too much. So for them, is their biggest fear is always instability, not so much on growth. They will be happy with 5-6% because that is a level that they have been comfortable with. That's a level of growth that they understood. That's a level of growth that the Chinese people are content with. They do not need that 15% growth. So basically, what we think is China is trying to defer this potential growth and stagger it through time. Now, if you look at this chart, the ISM Manufacturer Survey, the Customer Inventories Index, what we can see here is it's at all-time low levels right now at 27. Usually, levels of 45 to 55 is considered healthy. Anything below 45 is quite worrying or alarming, where inventories are too low. Now we are seeing at record low levels. There are a few reasons to it actually. Number one, these distributors or retailers are struggling actually to import the materials or import the goods that they want to sell to the customers. Demand is there. Problem here is they could not get it to their shores. So we are seeing problems with ports right now, logistic issues, which explain why there's such high freight costs right now. Shipping costs at it surged past the 10-year high, and I do believe that because of what we see here right now, consumption should remain strong for the next few quarters, because right now they are unable to even meet the demand of the consumers. After meeting that existing demand, there will be restocking. There will be a restocking phase, which requires more purchasing, more buying by these retailers or distributors. Hence, the strong orders that we see, with the manufacturers in China, in Malaysia, your exporters should remain strong for at least a few more quarters. Now, with that itself, we do believe that there will be a lot of trading going on. Now, the Baltic Index has surged past its 10-year peak. Obviously, if we look past the 10-year, then we are still seeing that it's nowhere close to where it was in 2008, 2009. So right now, we do believe that a lot of these logistic companies, freight companies, they are profitable right now. It was never sustainable to constantly lose money. We did speak to we did read about a few Chinese ship makers, their results, their quarterly announcements, where they indicated that orders are going up, that there are a lot of ship makers who believe that the current high rates are sustainable. Now, for us, when we look at this, we are trying to position ourselves, and we are looking to identify who would benefit, from these higher freight charges. or rates. Now, we did invest in one company that will benefit from the higher Supramax rates. And this company have been losing money for years. And it's quite decently run, but nevertheless, the whole industry itself, the structure itself, was just bad for everyone. So we never thought that it was sustainable for a company to consistently lose money. Hence why we think that the prices may stay at this level. And historically, the Baltic index tend to do better in the second half compared to the first half. And right now, with rates at the first half itself, assuming it being flattish, we are seeing companies trading at low single-digit PEs at this point of time. So we are starting to build a position in certain of these companies that will benefit from these higher rates. And we think that this could be sustainable, at least for a while. Now, in your second half, you have more economies reopening. That should benefit the Baltic index. Now, in this chart, what we're seeing is the Chinese domestic steel prices. So I do get this a lot where people ask me, wow, steel prices have gone up to ridiculously high levels, but why steel stocks in Malaysia is underperforming? Now, if you think about it, all commodity prices have done really well actually this year. Year to date, you are seeing more than 20-30% gains for most commodities. But the reversal actually began in May this year. It coincides with the reflation trade. Back then, when a lot of people actually invested in commodities because fear that inflation is getting out of hand, then when the high inflation numbers actually kicks in, surprisingly, people start to change their view and start to sell off commodities. Now, I would say a lot of these traders are anticipating that Feds may need to raise rates earlier than expected. They may indicate that they will taper earlier than expected, which is what happened in the last meeting. There was some indication. You see the Fed dot plot did change to the point where now they may increase the rates by end of 2023. So basically, investors are just reacting in anticipation of that. Now, for us, we do believe that steel stocks in Malaysia are a bit oversold at this point of time. Your Japanese, Korean steel stocks are down about 10-15%. Your Chinese steel stocks are also down around that level. Whereas a lot of your Malaysian steel stocks from its peaks down 30-40%. So we do think that it's in an oversold situation at this point of time. Now, what the Chinese government do really makes a big difference. They can really move these steel prices because about close to 60% of steel production comes from China. About 50% of the steel consumption also comes from China. So China is the biggest player in the steel market, without a doubt. Now, for us, we think that the Chinese government is trying to suppress steel prices. I mean, linear spike in steel prices like what we saw last month, it's just not sustainable. And it makes perfect sense for the government to try to suppress it, because if steel prices go up too much, inflation will spike, and they don't want inflation to spike. Now, on top of that, what we see here is the pollution issue in China. So Chinese government is stuck in between actually. They are trying to suppress steel price. And one way to suppress steel price is to increase production. But they cannot really do that. I think recently Tangshan announced that they have to cut their output by 30%. Now, why cut 30%? Because pollution got out of hand. In China, I think they realized that because of what they have done in the past few years, subsidizing all these loss-making business, especially in the steel industry, it's just killing their own people. Pollution is getting out of hand in China. Now, basically, I think they have took a turn in how they set their policies. Basically, right now, what we think is the Chinese government is going to subsidize another sector instead, the tech sector, which makes more sense, move up the value chain. Eventually, tech is the future. So what we can see here is the Chinese government is plowing money into the tech sector, electric vehicles, the battery technology, renewable energy. These are areas that they want to grow, and they are okay with losing money. So they will create jobs in these areas, but jobs will be lost in other areas, such as your steel industry. So we do believe that, going forward, the supply of steel from China itself will slowly dwindle downwards. Because if they were to try to achieve net carbon by 2050, they will need to shut down most of the industrial sector, which we don't think it will happen. So basically, we think that the steel sector itself should still have upside. Because, as much as Chinese government trying to suppress, by releasing reserves, we think that there's just very little they can do right now. Now, why I think that there's very little they can do to suppress steel prices? If you look at today, steel's price in China is actually trading at a discount to global steel prices. It's very difficult, for the Chinese government to constantly, suppress the steel prices in this manner. The American government, Biden is trying to push through its $1 trillion stimulus plan, infrastructure bill, which, we think that it will go through. If you look at the state in America, the infrastructure itself, they are far behind China today. The airports are badly maintained, roads are badly maintained, you have very old transit systems. There are a lot of areas that they need to upgrade, that they need to improve, or that they can reinvest in, which would require a lot of these industrial metals, steel being one of it. So we do believe that steel prices should hold. At least steel companies should still be profitable this year. Again, like shipping companies, we do not think that it's a sustainable belief that companies should constantly be loss-making. So people tend to be fearful of these high steel prices because they think that it's not sustainable. How can steel prices be this high? But you have to understand, steel prices have been declining for so long. Steel companies are loss-making. It's not sustainable, to continuously lose money. So we do believe that, eventually these steel companies will be profitable. So we are looking at, several companies where we think that there may be investment opportunities, especially after the significant sell-off. We didn't have much steel companies within our portfolio during the May, June sell-off, but we are looking to increase our position. Now, why everyone is worried of inflation, right? Historically, you see when inflation gets out of hand, that's when recession happens. Hence why people tend to, pay close attention to inflation levels. For us, we do believe that the inflation is transitory. Of course, inflation is high, what we saw in the last quarter itself. But if we were to compare to inflation during pre-COVID levels, January prices have only gone up about 2 to 3% compared to pre-COVID levels, And then because, again, it's the base that you use to measure your inflation. A lot of prices, especially in the service sector, actually crashed last year because of the pandemic. So, with a lower base, you are seeing a bigger growth. So for us, we think that's transitory. We do believe that US Fed will monitor the situation closely and take necessary action if inflation is starting to get out of hand. Now, if you look at this chart, what we can see is, the Fed balance sheet has been growing. Right now it's at close to $8 trillion. Every month, the US Feds are buying 120 billion, of bonds, securities. So there's just so much liquidity in the system. Even if they were to taper, we're talking about from 120 billion of monthly purchase to maybe 100 billion to 80 billion. Nevertheless, they are still pumping more money into the system. And let's not forget, interest rates are still at 0% right now. So for us, we do believe that the party will not end so soon because there's just too much money in the system. And what's the first course of action if the market were to correct deeply, or there was a huge sell-off in the market, and then the consumer confidence in America? We do believe that the Fed will go back to their playbook and start printing money again. So we think that they have been printing money and it have worked in the past. They will continue to do so. The Europeans are doing the same thing, pump priming, just printing money. Everyone's doing it. So we do believe that with so much liquidity in the system, stock markets will do well. Hence why this year the European stock markets are up close to 20% year to date. So the area which is actually the biggest laggard is the ASEAN region. Now, it's mainly also because of the COVID situation. If we look at this chart, where we stand compared to the global average, and when compared to the European nation, America, we are far behind. But we are moving towards there. Vaccines are being more available right now, and because US and Europe have a large portion of the population being vaccinated, they may no longer hoard as much vaccine as they used to. So there will be more vaccine available for the emerging markets, the ASEAN countries, which is something that we are seeing right now. So for us, government is actually vaccinating about 200,000, giving out 200,000 doses a day right now. So if we look at it from a weekly perspective, that's about 4% of our population with a single dose. Now, we do believe that, in 3 months' time, that 50% of our population should be fully vaccinated. Now, it's how to get the remaining 20-30% of the population vaccinated. That is the only way for us to reach herd immunity. So that, so that would be I would say, the biggest concern for most countries actually. Getting the remaining 30-40% of the population vaccinated. Because it's estimated that you need 70-80% of vaccination among your population to reach herd immunity. So I think that will be one of the biggest challenges we face. But nevertheless, we are moving towards that. And if you look at what happened in Singapore, Singaporean government actually mentioned that they are going to consider changing the way they report new COVID-19 cases. They are trying to move past this COVID-19 situation and, trying to move back to the normal times, where people treat COVID-19 like flu, influenza. So basically, they will only report, hospitalized cases. So we do believe that once a large population being vaccinated globally, slowly people will start to move on with their lives, start to travel again. And then we do believe that the areas where got hit hardest should see inflows from foreigners. Because if foreigners have sold or, redeemed or, withdrew from these markets because of the spike in COVID-19 cases, a reversal should result into a reversal in the actions as well. Hence, higher inflows. Hence, we do believe that next year could potentially be a good year for Malaysia. You have your pre-election rally potentially, and with COVID-19 cases out of the way, we do believe that Malaysia is an attractive tourist destination for foreigners. Now, so basically, this is the chart of the KAF Tactical Performance relative to my benchmarks. Since I've taken over the fund in January 2016, we have outperformed the indexes, whether it's your KLCI or EMAS, consistently during this period. the only period that we actually didn't do so well was actually in 2018. Other than that, we have outperformed every single year, both our benchmarks. And if you look at where our benchmarks stand at this point of time, since 2016 till today, it's actually basically flattish, whereby tactical is up 110%. So we outperform our benchmark by 110% during this period. So for me as a fund manager, we constantly look for ways to outperform. And tactical being a thematic strategic fund, how we work is we always allocate a certain portion of our fund to invest in thematic ideas, to ride with the trend, areas that we think will benefit in the short term. And also we will allocate a certain amount of funds to invest in our core ideas, where we think that it may take longer than expected to materialize for. So an area that we are very excited of right now is the tourism and leisure sector. One of our largest holding is actually a travel insurance company, specialized travel insurance company, who used to have a large portion of their revenue coming from travel insurance, but right now, because of the COVID situation, only a small portion comes from travel insurance. Nevertheless, why we prefer this over airlines, it's mainly because this company is actually a profitable company right now. Whereby if you were to invest in other areas, other sectors, they are loss-making companies who may need to raise funds, to weather through this period. So airlines are losing hundreds of millions every quarter. So when things were to turn around, as a minority shareholder, the question we ask is, how much stake do we actually own in the company after the rounds of fundraising? Hence why we do believe that investing in this travel insurance company is a better proxy to the whole sector itself, because it's profitable right now. And when people start traveling again, which I truly believe people will, people that I speak to who travel once or twice a year, they were saying that they will increase the frequency of traveling, because for the last 2 years, for them it's like a lost year. So for us, we think that for the first 2 years, travel demand will spike. It'll be very similar to the pent-up demand that we see in rubber gloves. We are going to see inflated profit margins for at least a year or two. Then obviously comes with inflated profit margin, you're going to see higher revenue as well. So hence, you'll see profits not just going up slightly. There's potentially profits could go up multiple folds. Hence, these stocks could be multi-baggers in the making. So this is one area we are quite excited with. We are constantly looking for opportunities within this space. Stocks that are trading at 20, 30, 40% below its pre-COVID prices. Areas that we think that the earnings could rebound significantly, not only from its pre-COVID levels, but being able to show or deliver stronger growth than its pre-COVID levels. So basically, this is our strategy going forward. For our near-term investments, we are looking at opportunities in the freight shipping industry. We are looking for opportunities in the steel sector because we do think that it's an oversold situation. As for tech itself, we used to have a lot of tech last year, but we are slowly trimming our position, slowly transitioning away to reopening trades, because we do believe that eventually when the borders were to reopen, people will eventually spend more of their income or savings to services than consumption itself. So we think that they will buy less gadgets, they will buy less household goods, household consumer appliances, and spend more on lifestyle, traveling, eating out, so we do believe that there may be a shift in the spending by consumers around the world. So hence why we are slowly transitioning from our tech holdings to our reopening place. because we think that going forward, you know, it may be 6 to 12 months down the road, but we are optimistic of that sector or segment itself. I would like to conclude my presentation today. Thank you very much for attending this webinar and you know, dialing in, listening, you know, sparing your time to listen to my presentation today. Thank you.